one announcement next Thursday at 4 o'clock USA. We're having a USAA day. So I really want students to go because we're trying to build that relationship strong with USAA. So if you go, I'll give you an extra attendance makeup. Instead of 3, you can get 4, but you have to be there. I have to somehow figure out who's there. And those in 2 classes, you have to decide. You'll probably have 100% attendance anyway, but so 4 o'clock, USA is going to do an opening presentation, and then they're going to break into tables. And they promise to keep the applications open until after this meeting, so you can hear about it and apply there. Good company, got some really sophisticated things, and some really sharp people working there. All right, so if you come in a little later, get your your paper 1 from me before you leave. Let's see. So I handed out the comments. There's got to be many typos in there. So if you see typos, you can't figure it out, let me know. I don't know if you've ever tried typing in Excel. It just doesn't work too well. And my neighbors heard me printing these because it kept messing up, and I was getting so frustrated. Oh my word. And then I'm getting to the last one, and it's saying ink is running out of your printer, and I don't like to have any more ink. So it was a pain. So my goal was to get it all fit on one page. That's why the type is so small. So come grab it afterwards. If you have questions, let me know. So you have until the end of the semester to update it. Once you submit, I'll give you 1 submission. So I don't want to have to grade things 4 and 5 times. So if you're not sure and you're updating it, now, let's say you got 1 low score on one thing, you want to come by and talk to me or set up a Zoom before you resubmit it. We can certainly do that. So you make sure you get it. I gave you comments even on things you did well. So just things you could think about to enhance it. So, so any questions on that? Now, I'm probably not going to be giving you comments on all the papers. So it's very time consuming. It took me a long time. It takes me long enough just to read the papers, but to be typing comments as I go. So I probably won't be doing that on every paper. So on the future papers, you'll probably just have to look at the rubric, and you have to come ask me why you got a certain grade on that particular thing, just because it's just not possible for me to do that. So, but you do have until the end of the semester. All right, let me do one quick. Acts, Hieronymo, Genesis, Dante, Julia. So yeah, the Muhammad, Dante, Julia, and somebody else. Lance, come get your paper. You can come get them now if you want to, but come get your paper. Let's do one quick look at paper 2 one last time, just to make sure. So you're going to start off with just a description of your firm. What did it do? You want to link it back to paper 1 as much as you can. Who are their main products? Who are the customers? What their geographic landscape is. Market share, a couple of numbers can work really well. Growth, how their earnings, their revenues have grown over the last few years. A high-level history of the company. Don't go crazy on that, but some sense of who they are. I mean, there's some companies, you take a company like Western Union, their history is really fascinating, really interesting. So just from just interest, it's kind of interesting, but don't go too wild. If there's been any major merger acquisition, like Exxon Mobil, obviously that was a big part of their history. You'd want to talk about that. And what is unique about this company? What distinguishes it from other companies? A short and relevant. I'm hoping this class will be the exception and give me a better management biographies. I don't need biographies. I want to know what their strategic focus is. So I really want on this one, this is where I really want to go out to the internet and try to find good videos of the CEO of your company talking about the company. What does the CEO of your company say? So I found there's so many good ones of Costco. That one, there's just plenty of him talking about the limited SKU and keeping prices down. Management of these, all you have firms that are large enough that their CEOs are important people. They're getting interviewed a lot. They're on the press. They're getting interviewed by, all kinds of TV shows and programs. They speak at conferences. A lot of times those conferences are available on YouTube. So I try to hear it coming straight from the CEO, what they view their company is, what their strategic focus is, what they're really trying to do. they've got to sell their company, and they're not selling their company to the general public generally. They're selling it to sophisticated investors, and those are the videos you're looking for when management's talking to senior management. This might be a time to at least experiment with the earnings conference call and just listen through. You might be fast forwarding a lot because they can be pretty tedious, but if you're at the gym, if it's an hour, hour and a half long, just listen to it. You might fall asleep while you're on the treadmill, but at least you hear the CEO, hear what they're saying. I say possible, you really want to try to get an ESG section in. I showed you what Bloomberg shows on governance. I still need to go to Bloomberg and see what they have. I keep forgetting to do that. But who are the major stockholders? If you have family ownership, those are critical. Are there any major stockholders that are unusual other than the large institutional investors? Are there any activist stockholders? Those type of things. Are there any special shares? The environmental and social, you can use the Bloomberg for that. I'm not as concerned about that, but it is something. Just when you put it on LinkedIn, it's just you want to have a section that says ESG for your company. And then really, really important, we talked about that, their competitive position in the industry. What is it that they have that distinguishes them, and is it sustainable? Is it an advantage? How big of an advantage is it? What are they doing to maintain it? What's their CapEx? What are they doing to keep that edge over their competition? You do a SWOT analysis, which MarketLine will give you some of that, but just on your own. MarketLine's a good place to go to make sure you're not missing the obvious ones. Also, reading the firm's annual report is a good way to try to figure out strengths, weaknesses, opportunities, and threats. And then you need a final conclusion. That's one area a lot of y'all have really struggled. I got a lot of conclusions where this technology is going to be important to this firm, blah, 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 but you didn't tell me if the firms are going to grow faster or slower. You just said, here's the keys to figuring out the growth of this company, but if you don't actually tell me what you think that growth is going to be, then you're leaving up to the reader. So you got to make something. You say, hey, this technology really depends on what AI is going to do next 10 years. And I think AI is going to take over and this firm's really going to grow fast. You got to, I actually don't believe in it. I actually don't think we know the future, but for security analysts, you got to make a bold claims and confidently on stuff we don't have a clue about. And it's just the nature of the business. You just got to say, hey, AI is going to take over, and you got to say it in a very positive way. So make it really strong on your company, just like you need to do for the industry. Is this industry set up for good growth or weak growth or average growth? Is this company? And here, what you do a little bit different with this company, with the company paper. So for the industry, you're talking about the industry. For your company paper, it's both the industry and their position in the industry. So you got both. Is the industry growing, and is their market share growing? So you have to, it's a little bit an additional angle there. So if the industry growing 10%, but they're only growing 7%, then they're losing market share to somebody. To whom are they losing market share? That's the kind of thought. It could be an Intel losing market share because their semiconductors go on products that not growing as fast as, say, autonomous vehicles or something. So that's what you're really looking for. Any questions on paper 2? You've got a month before it's due, so you got some time. You want to try to get it pretty well drafted this week, get it as far out of the way as you can, so you can start looking at paper 3 next week. I feel comfortable with that one. It's not a overly complex paper. You're really relying on MarketLine, but much more. If you haven't gotten to your firm's annual report, this is the time to do it. See what specifically they're saying about the company. Okay. So let's walk through this analysis. Hopefully everybody's got their data from Capital IQ. If you haven't, email me and I'll get the data for you. If you want me to get the data for you, you need to set up that Russell file.
I'm sorry, the conference call is normally for the one day you find the company's website.
Company's website, Bloomberg has them as well. If you go to Bloomberg, you can.
Is the CEO talking about?
Well, it's a presentation, so the CEO will probably talk for a little bit, and the CFO will probably talk for quite a bit, and then you have the questions coming in from the sell side research. It can be exciting. I mean, Elon Musk, his can been quite entertaining, and they can be incredibly boring. It's almost like, especially if a firm's struggling, they almost want to just everything's boring, everything's fine, and it's like just because they don't want to freak people out. But yeah, they can be interesting. They can be sometimes they get into such minutia. You're like, why do we care about this? That's not that important. But right. So there's the Russell file. I just don't know if I saved it anywhere. So if you want me to pull your data, you can either catch me in the FSC and we'll pull it in there. We got the one machine that is working. Or you can email me file, but if you email me your file, but if you email me your file, I need to see your company with all the competitors. And I sent y'all a video shows you how to do that. So if you can't get your data, at least get the Russell 3000 file set up and send me that, and then I'll create your. It usually only takes me 5 minutes to create it and send it back to you, and I'll copy it as values so you can read. So this is really, really important. Probably even Thursday night, we're going to need this. We might get into it a little bit tonight. All right. So if you remember our template, you start off with just, is this firm viable? And once you say, yeah, they're going to survive, then you're going to start focusing on growth. So tonight, let's talk some on liquidity. So there's two aspects of liquidity. We're not going to spend so much on the second one as the first one. The first aspect is their operations. Is their operations generating cash or eating up cash? For most firms, their operations eat up cash. There are a few firms whose operations actually generate cash. So it's called, some people call it the cash conversion cycle, the operating cycle. The other aspect of liquidity is if they had some major liquidity crisis, they needed $3 billion overnight, where would they get it from? We're not focusing on that. That could be their debt lines. We used to do that at USAA in quite a bit of detail. If USAA needed $10 billion in cash overnight, where would we get it? How much could we borrow? How much could we get out of the asset side? We're not focused on that. You can certainly talk about it in the liquidity section, but it's not part of the template. So the source of liquidity we're not really getting into. So we're going to really focus in on this operating cycle, the cash conversion cycle. And if you think about the cash conversion cycle for a real traditional firm, they go out and buy raw materials. So there's cash going out the door. Then they got to pay their operations people to build whatever it is they're doing. So Ford goes out and buys steel. The steel comes to the plant. They got to store it. That costs money. Then they have their workers build a car. That's going to cost money, the electricity. Then they send the car to the dealerships. It sits on the dealerships lots for a while. That's a cash drain. And then they sell the car, but they sell it on credit, so they don't get the cash. So they're out of cash for a long, long time. And then person buys a car and pays it off over 7 years. So their cash conversion cycle is very, very lengthy. They're out of cash for a very, very long time. So that's the typical. You pay up front to your vendors, you sell to your customers, they pay you they give you an IOU and they pay you later. So you're trying to figure out how long is that cycle. And the key to this are your working capital assets. We call it the net working capital requirement. The net working capital requirement is looking at those working capital assets minus those working capital liabilities and trying to see if it's a positive or negative number. So here's where I blow your mind. You have to forget what they taught you in accounting because it wasn't correct. So I keep begging some accounting professor, we debate this in public. I'd love to take them on. So the accountants have the current ratio. They even ask them on the fact exam, which I don't like. We don't use the current ratio in finance. It doesn't tell us anything about liquidity. It's just not a useful ratio. Why is that? Well, because finance, we don't like receivables, inventories, and prepaids. They're terrible assets. What return does your inventory give you while it's sitting in the warehouse? Probably negative, right? Because it's going obsolete. It's just sitting there. You had to pay for the storage. You already paid for it. You gave your vendors money. It's just sitting there. If your apartment complex lets you pay rent at the end of the month, would you do that? Will they let you do that? They won't. You have to pay at the beginning of the month. You'd rather pay at the end of the month. That'd be nice. But they're not gonna let you do that. You gotta pay up front. What return did they pay you for loaning them money for a month? What interest rate did they pay you? 0%. How many 0% returning assets do you want on your balance sheet? I don't want any. Accounts receivable for a lot of times is a zero returning asset as well. And in fact, if you're retail, it's probably negative returning because they're using a credit card and you have to pay the exchange fees. So that's killing. You'd much rather they not do that. They probably prefer a debit card, but I don't know. So these are zero returning assets. They use a lot of cash. Inventory uses a lot of cash because you got to buy the inventory. Prepaid, paying for rent in advance, you don't get anything when you pay it. You have to go through the whole lease cycle for it to make sense. Accounts receivable, you'd much rather your customers pay you than have an accounts receivable. So we hate these. These are terrible assets. And then accounts payable and accrued expenses, those are usually liabilities with no cost. Now, accounts payable, you could have the 210, net 30 kind of things. We're going to kind of ignore that. But for the most part, accounts payable is very cheap funding. Accrued expenses is absolutely free. So USAA paid me every 2 weeks, but they paid me for 2 weeks a week later. So I'm getting paid 2 and 3 weeks late. What interest rate does USAA pay me on that? 0. I'm loaning them money for free. If someone loans you money at 0% interest, how much would you borrow? I'd borrow a few $1 trillion and invest it, right? So you have interest-free liabilities and unearned revenues. None of you are doing airlines, but that's a huge benefit. The airlines, there's so much negative you can say about airlines. This is their one big positive. You buy an airplane ticket 6 months from now. When do you pay the airline? Today. What interest are they paying you on that? Nothing. They may actually penalize you if you change your mind and charge you $100 to change flights, even though it didn't really harm. They could have done that all electronically. The airline I used this summer, they canceled my flight, rescheduled it. I already paid for luggage, so I had to pay luggage again. And they're like, "We can't reimburse your luggage." And I'm like, "What? I got to pay for luggage twice, including." And they was like, "No, we can't reimburse you." And I said, "But you canceled the flight." They finally reimbursed me, but I was like, "This is crazy. Why would I pay for luggage on a flight I didn't take?" So they love this. This is like their one big thing, and it's huge. You look at airlines. This is a huge liability for them. Interest-free liability produces massive cash flows for them. So if this is a negative number, that's good. All right. If this is a negative number, it is good. I don't know if I can show you this. So let's see if I can do this. See if I can log in real quick, just a second. See if I can remember my password. But it's probably going to make me have to. Oh, sorry, I forget that. Maybe I'll show y'all next time. I forget. Google makes me get on my phone to check it. So, yeah, you want this to be a negative number. So I'll show y'all next week, our next class, if I remember. The business breakdowns on AutoZone it's so funny with AutoZone. I don't know when the accountants listen to this if it confuses them. But the story with AutoZone is their goal is to have inventory always in stock. When you show up and you need some part on some car, it's there in the store, you can get it. That sounds horrible, doesn't it? You have this massive inventory that just sits there for months. And on the business breakdown, the interviewer says, "Well, that must be terrible for working capital." And he said, "No, they actually have negative working capital." An accountant would hear that and say, "That's terrible. You mean their working capital liabilities are greater than their working capital assets?" He said it as a good thing. And the interviewer says, "How is that even possible? That's ridiculous. How can they have negative working capital?" And they're all talking about it like a good thing. Accountant's like, "Yeah, that's terrible." And they're saying, "No, this is wonderful." So how could a firm with large inventory have a negative working capital? And the reason for it is AutoZone is such a highly respected firm that they don't pay their vendors. They pay their vendors well after the fact. So how did they get away with that? Because they're so highly respected, their vendors can take that accounts receivable from AutoZone, go to their bank, factor that, and get their cash today. And then the bank will collect from AutoZone later. And so they have this set up that their accounts payable is so large, even though the inventory is large, this equation is still negative. And business breakdown, without explaining it, they don't explain, oh, let me explain why negative working capital is good. They just assume anyone listening understands that negative working capital is a good thing. And so they offset this heavy inventory requirement by keeping very large accounts payable. And so instead of paying their vendors for the inventory, they get the inventory and they give their vendors an IOU. No cash changes hands. They have a positive cash flow. So the net working capital is negative. All right. So accounts receivable, y'all know what that is. Now, Costco or Chipotle, do they have accounts receivables? Walmart has an accounts receivable, but I'm not really sure what it is. Maybe it's from Visa and MasterCard. I don't know. Or from Bank of America. So they have $155 million in receivables out of $7 billion in assets. So it's not huge, but what is it? I have no idea what that is. You need to figure that out. It's only $155 million. So maybe you don't care. What's their biggest asset? Their inventory is really, really low too. So they don't have a lot of operating assets at all. They have $800 million, $900 million in cash, but that's not a working capital asset. A working capital asset is tied to your operations. Receivables, inventory, cash is not a working capital asset. Cash is the result of operations. Short-term debt is not a working capital liability. Short-term debt is the result of working capital. So if your working capital is a positive number, you use debt to fill in the gap. If your working capital is a negative number, then you have cash as a result. You're just actually producing cash. They have massive payables. So those of you doing Chipotle, figuring out what that mashup, now it does say accrued expenses as well. Let's see if we can break that out. So most of it's accrued. That's probably their payables to their employees for pay and those kind of things. They do have some payables. Their payables are greater than their receivables and inventory. But even you look at a Walmart has massive inventory, $57 billion. But they have $8 billion in receivables. Again, I don't know what that number is. It's pretty small relative to their assets, but they do have accounts receivable. So you know what inventory is. Most of your firms, some of your firms probably have no inventories. So Claudia, I don't know if you've looked at UPS. Does UPS have inventories? Are you doing UPS or FedEx? I can't remember. UPS. Yeah, they show $900 million. It's really small. It's only like 2% of their assets. But what inventory does UPS have? Is that like boxes or stuff? Do they sell boxes and covers? So who knows what that might be? It's a pretty small number. The receivables is high. That's the number you're gonna have to research. That's a pretty massive number. Their accounts receivable, $13 billion. That's almost, well, that's a big chunk of their, and they even have doubtful accounts. So who knows what that is? So that's something you'll have to do a little bit of research on. All right. So if this number is negative, the firm probably has no serious liquidity problems. Their operations actually generates cash. They're never out of cash. All right. So and prepaid, accounts payable, accrued expenses, and then unearned revenue. I would check on unearned revenue for your firms and just see. It might be in other, so you have to kind of check and see. Look through this. This is when you might need to get into the annual report to kind of look at those details. That's how we found with Chipotle. Chipotle has no debt. And then you look at the, is this Chipotle? Was it Chipotle? I think it was. So you look at the current debt and you see that they don't have debt, they have capital leases. So they went from zero debt to zero debt, but it looked like they went to a debt number because they have capital leases. I think I'm under current. So let's do non-current. Yeah, there we go. So it looks like they have $3.5 billion in debt, but that's all capital leases. So they essentially have zero debt and they have capital leases. The accounting for capital leases changed a few years ago, I think much better way. And that's probably why suddenly, so it's real frustrating for y'all who's doing Chipotle. Capital IQ shows all this debt and there's just no interest expense. And so how do you handle that? So, you know, you can see it, they do break it out on this report. All right. But unearned revenue, they don't break it out on Yahoo Finance. I don't see it. They say deferred revenue. I'm not sure that's unearned revenue. Could be. So a positive number means the operating cycle is using cash. A negative number means it's a source of cash, which means they're probably very liquid. So if we compare, let's think about the accountants here. So Walmart, is Walmart a liquid or illiquid company? What do the accountants say? So let's look at what the accountants say. So the accountants use the current ratio. What is the current ratio? Current assets divided by current liabilities. That number needs to be above 1. What is Walmart's? 62 billion versus 78 billion. It's below 1. Accountants say that's an illiquid company. Is Walmart an illiquid company? So I've had some accountants say, well, it gives you some insight on liquidity. Well, I'd ask the question, why is Walmart's current ratio below 1? And they say, well, it's just some string accounting. No, it's not strange accounting. Their ratio is below 1 because they are liquid. The ratio the accountants say measures liquidity is below 1 because this firm is liquid. So the liquidity ratio actually is the exact opposite of what it should be. Why are they liquid? Because their current assets are smaller than their accounts payable because they don't waste money on inventory. They're really good at inventory management. They tell their vendors we'll pay you when we feel like it because they're 25% of the retail area. That is good, and yet the accountants say it's negative. The other thing accountants say, well, it tells you something, you look at over time. Yeah, I'm going to say none of that's valuable because anything that the current ratio does tell you that's useful, the net working capital requirement is going to tell you as well, and even better. So I say throw out the current ratio, throw out the acid test ratio, just look at net working capital requirement. That's all you need. So, and I'll show you how I actually put it into the paper. Questions on that? Am I like someone want to defend the accountants? I've got a CPA, so I can badmouth accountants. So you got to get your CPA to be able to badmouth accountants. But you always know when you have an accountant's doing finance because they always do the current ratio. As you go to banks, current ratio, get your current ratio. It's like, yeah, whatever, here it is. So how do you improve this? So it's managing your receivables and inventory and payables process. Firms like Walmart, firms like Costco, grocery stores, this is their business. Managing receivables and managing inventories is their business. They've got to be better at that than anybody else because that's the entire thing they do. That's that supply chain management. We're going to look, when we look at turnover, there's a lot of activity ratios that measure this. You remember those: receivable turnover, inventory turnover, those type of ratios that we can look at to see if they're getting better or getting worse at these ratios. Obviously, there's going to be some industry influences on these as well. Certain industries have certain types of payables and receivables and inventories that are going to you're going to see them in the numbers. And generally, firms that are growing fast are going to have a little bit more trouble with this than others. And so a fast growing firm may have inventories build up because they're growing so fast, they just got to stockpile the inventories to get that, get ahead of the sales growth. Older companies, they tend to be late in their life cycle, so they tend to have working capital requirements that are generating cash. So you can be liquid because you're just not growing very fast. Younger companies, this can be a major issue. You can actually put them out of business if they don't manage it well. I was working with one company. They had this new software package. Boy, it was selling so well. And the CFO came in and they had in their contract that said the client doesn't have to pay them until they cure the software. And so they had the software everywhere and it's brand new. So there's all bugs in it. And so they were selling it because the sales force got this commission. The problem was no one was paying them because it had to be fixed. And the CFO said, well, you can keep selling and we go out of business, or you can go back and fix the software problems for the customers you sold to so that they will pay us. That's your choice. Out of business, that big commission you're building, you won't get it because we don't have any cash, or you can go back. So he had to tell the sales force, you have no choice. You got to go back and fix that software because we got to get paid. So fast growing companies, sometimes that can be the death of them is because they just cannot handle the working capital requirement. Some firms handle it, obviously, on the inventory side with just-in-time inventory. You want that inventory to show up right on time. I don't know if y'all took a management science class where they do the optimal order point and all those kind of things. I don't know, you have to deal with that in your firm some. What is it called? TQ or something. Like, it's been a while since I've had those. So y'all seen those kind of things? When's the optimal time? You know, you got the out rate and how long it's going to take to deliver and how much it costs to deliver, all those kind of things. The problem with this is if you're managing inventory razor thin and then Putin decides to invade Ukraine, you may have a little bit of a problem. You can't get your hands on it, or COVID shows up and people in China can't even go to the factory because the government won't let them. Or Tokyo has an earthquake and suddenly auto parks aren't available around the world. So just-in-time inventory is really good for managing working capital down, but it does create much bigger risk in those extreme cases. So if I were going to be in the retail industry and I wanted to be a retail security analyst, I would try really hard to get a job at H-E-B or Kroger's and get on the supply chain management side. I'd want to see. I mean, that's what you could do when you work for a firm. You got to find the most complicated part of the firm. For a grocery store, it's going to be that supply chain management. You want to work there, figure out what they're doing, how they're managing it, what's the software they use. I don't know how many of y'all were in Investment Society when Valero spoke. Was that last week? I can't remember. 2 weeks ago. Pretty complicated process, wasn't it? How they manage that gasoline going around the world, stuff coming in, going out. It's a very complicated process. A lot of it's set up. I was thinking it's maybe AI and set up, and he said there was a lot of human intervention coming in to kind of fix that. Last year in my risk management class, I don't know if any of y'all were in that class. I can't remember. Buddy and Lance, y'all were in there. You remember the United Airlines guy talking about the scheduling? Boy, that was complicated. You got people all over the world. They may be in Phoenix and you need them in California. And this is the kind of thing firms have got to be really, really good at this because this is their business. If you look at Peloton, COVID should have been their biggest sales year ever. All these people are home. They want to exercise, but they don't have product to sell. They can't get supplies. They can't build. That's a disaster, right? Someone really, really messed up there. So you need your firm to be really, if you're in the retail side, you need your firm to be absolutely the best on this. Now on UPS and FedEx, it might be an issue of having drivers show up at the right time, how things show, the transportation, that whole transportation logistics is pretty massive, pretty important. As Jade brought out in his paper, pretty important stuff. All right, so your cash conversion cycle is how many days do your sales stay outstanding until you collect? How many days do your inventories sit around before they get sold? And then how long do you have until you have to pay your vendors? And here's the turnover ratios. Accounts receivable divided by sales divided by 365. Inventory divided, we don't use sales, we use cost of goods sold. So y'all remember these formulas. These first two formulas I actually pulled from Capital IQ. So you want it to be a lower number is better. You don't want a high number. So how long does it take for your receivables? Maybe that's 6 or 7 days if you're a Walmart. Inventory, you don't want that to be, 80, 90 days. If you're a grocery store, you don't want to be, a week or so. So those ratios, you don't have to actually calculate the ratios. They're already calculated for you. You can use them in your paper and talk about if you want to do more depth. So I'll show you where they are in the actual capital IQ. I don't have them in any of the charts, but if you want to use them, you can create your own chart. Significant unearned revenue can be tremendous for some industries. So we'll talk about turnover ratios later when we talk about revenue, but there's a close tie between revenue turnover and liquidity. Because if you can improve accounts receivable, inventory turnover, you're also going to improve your sales efficiency. So we'll get into that a little bit later. So there's somewhat of a matching concept here. If your net working capital is a use of cash, if it's a permanent use, you're always using cash, you probably want to fund that with long-term debt. If your net working capital requirement is somewhat permanent and then the holiday season comes and suddenly it's massive, that big change in working capital, you can fund that with short-term debt, but you don't want to overuse short-term debt. So a lot of retailers, because in November, December, January, they'll probably borrow money for that working capital, and the rest of the year they'll fund it with longer-term debt. So long-term finances is long-term debt and issuing stock to retained earnings. Those are the ways you can fund that. We're not going to talk about short-term debt. I probably should put it in the paper, but a firm that overuses short-term debt, they've got a couple of risks. One is the interest rate risk. When interest rates rise, you think about it from 2020 to today, short-term debt is like five times larger. They're going to see that interest expense really shoot up. And then you have the funding risk. You have things like 2008, even during COVID. If you're constantly using short-term debt, you're going back to the market constantly. If you get a frozen market where there's no lenders, you're in a lot of trouble. You just can't roll the debt over. So most firms, you can look at it at your firm and see, I still got Walmart here. So their current debt is 4.5 billion. Their long-term debt is 34 billion. So most of their debt is long-term, locked in. But they do have something. And remember, the current debt isn't short-term. The current debt is just, it can be short-term, but it can just be the long-term debt that just is due in the next year. So it doesn't necessarily mean they're borrowing short-term. I don't know if they break this up. But you can get out of the annual report. How much of it is, so what is short-term debt? What is that called for corporation? Remember that? Commercial paper, yeah. So commercial paper versus medium-term notes. So commercial paper that is short-term, it's going to move with interest rates. It refinances constantly. It's a constant going back to the market, borrowing money. Medium-term notes, longer-term notes, those, they mature and they usually roll over, but you want them to ladder those out. But we're not going to spend much time on that, but you certainly could put that into your analysis if it's big for your firm. So the accountants use the net working capital, which is current assets minus current liabilities. We're not going to use that at all. We're completely ignoring that. We're not going to use the current ratio at all. We're going to ignore that. So that's the traditional view. What about Dell Computer? One thing with Dell Computer is, let's see if they're making money. The longest time they were losing, yeah, they're making money now, but for the longest time they were losing money with $100 billion in revenue. How do you have $100 billion in revenue and lose money? But they've turned the cycle around, so they're actually making money now. So if you look at them, their current assets are 45 billion. Their current liabilities are 56 billion. It's another firm with a current ratio below 1. And Dell's reputation for being an extremely liquid firm. The reputation was they don't build your PC until you order it. So they don't have inventory just sitting there. And that's why they're just it's a very liquid company, and yet the ratio gives the exact opposite. If we look at a United Airlines, let's see where that unearned revenue is. See if they show it. It's probably this $10 billion out of 67 billion. That's a pretty massive number. There may be other things in there. Yeah, I'm guessing that's probably the bulk of it there. It was pretty amazing in 2020. They were really quick to reimburse that. Can you imagine the cash flow hit that had for the airlines when they were reimbursing all of that money in the Carnival Cruise and those type of things? Companies, boy, it must have been devastating. Right now, anybody want to defend the current ratio? I won't remember when I'm grading your paper, so you can argue the other side. Do y'all want to see a debate with accounting versus finance? Huh? Do you use it all the time? You should never use it. I have finance majors that when you ask them to do financial analysis, this is the first ratio they pick, and then they can't think of any others. It's like, where? So they learn all their financial analysis from accountants. So yeah, it's just, I've heard accounting professors say, this is a ratio for liquidity. Sometimes it doesn't work well. It gives a mixed picture. And I'm like, yeah, but why use it at all? Just leave it completely out.
If they need to liquidate their stuff like quickly, they're able to satisfy short-term liabilities.
Yeah, you're not going to pay your employees with inventories. And if you're bankrupt, you're going to have a tough time selling the inventories. And if you're bankrupt, there's a good chance your accounts receivable will just say, hey, come after me, sue me. You know, I kind of hope if I had a mortgage, I kind of hope my bank goes insolvent. Kind of being kind of nice. Maybe they forget about me and lose the mortgage. But yeah, I don't think you can pay current liabilities with current assets. They're just not, and even with the asset ratio, I just don't think you're going to do that. You're going to have to, you're out of business. You're out of business, and they'll liquidate. But that's a pretty rare example. Even, you know, it doesn't happen all that often. All right. So what are you going to look at with liquidity? You want to look at trends in cash from operations. We're going to do that one. That one's pretty simple. Is working capital a source or a use? I say how it compares to the industry. I'm not actually doing that in our papers, so you don't have that, but that's something you want to look at. Trends in the working capital requirement, we're going to do that. Use and structure of debt, fixed rate versus floating, we're not going to do that one. Sources of liquidity, we're not going to talk about that one, but your total debt program, your debt sources, your backup lines, your alternative sources, we're not going to look at that one, but that can be pretty important. Any potential liquidity shocks that you might have. You have one customer that's a huge part of your business, those type of things that could be a potential. We're not going to cover that one. And then trends and free cash flow, we're going to kind of cover that one. So for our project, let's say individual project one, sorry, that's different. You can take that out. So these are the things we're going to look at, these three, and you'll see it. So let me show you how to do it in Walmart. So y'all know this document's out there, right? So for your paper 3, you can copy and paste this and make it, you don't need this introductory part. It doesn't really make sense in the middle of a paper to have another introductory abstract. So just leave out that first part. You don't have to put this up here. You don't have to do the big capital letter either. So we're going to do liquidity. We're going to look at 3 things. First, cash from operations. Second, the working capital requirement. And third is how they use do they have free cash flow? And that's going to be 2 charts. All right. So let's get comfortable with this chart. How many of y'all have your data now? A couple of y'all. How many don't? Then is that everybody else? So what do you need? So you start off. I have this file, this sheet, as a separate file. And the reason I do that is you want to get your company at the top with a 2 and all the competitors you want with a 1. And once you do that, you sort it so that those all are at the top. And if you do that in Capital IQ, it's going to recalculate every time you do it. So that's why I gave you just a Russell 3000. If you can't get your data, at least give me this file, just this sheet with who you want as competitors. So I don't know if we've tried this before. Have I worked out through this? I think it's a little bit, did I? On how to get the 1s and 2s, we did that. All right. So The spreadsheet goes through, one thing to be careful of the spreadsheet, well, I think I fixed it, so you don't have that issue. No, I didn't in this one. Oh, this is an older version. So this isn't the one that's out there for y'all. So I adjusted this so that if you only have like 20 companies, it will stop at 20. It won't bring in Apple and all the others. Make sure right here in D5, you put your company name in there. So let's look at this printout. So liquidity, we're going to look at cash from operations. We're going to look at the net working capital requirement. And we're going to look at how they're spending their money. So those are the three things we're looking at, okay? The first question is just, is cash from operations growing or not? Now, what stands out for you for Walmart? Can you see COVID at all? Pretty massive, isn't it? That was like an amazing windfall from them, $36 billion all in 1 year. Their revenues shot up as well. So you're seeing some bouncing around here. We're going to talk about how do you figure out why this thing is bouncing around so much more volatile than net income. What's going on? Why did that jump up? Is that entirely COVID or is there other things going on? The growth rate is only 2%. And that's the CAGR. Remember what the CAGR is? What's the formula for CAGR? You're going to use that like a million times in your career. Not -1 yet. CAGR is annual. Yeah. 1 over N. Now -1. Now what is N? If I got 10 years of data, what is N? It's 9, right? Because it's not the number of years, it's the number of growth periods. So if you have 2 years, you only have 1 growth rate. If you have 3 years, you only have 2 growth rates, right? So if you have 10 years, your N is 9. Right, so that's your CAGR. If you look at that, oh, boy, you can't see it. So if you look at it, it's ending over beginning to the 1 over 9. The reason I'm showing you this is what some students have to do here is insert a column C so they can do growth rates off of different years. Because it's possible, one of the errors with a CAGR is only looking at 2 years, your beginning year and your ending year. It ignores everything in between. So if you're trying to figure out, especially if your first year is really, really unusual, something strange happened in the first year, you might want to say, you know what, 2013 was just too strange. Let me use 2014. Then you have to change it to 1 over 8, but you can put that in there as well. All right. Is 2.4% a good number? Well, you could calculate inflation. Maybe I should do that. Inflation over the last 10 years has probably been around 2%. So they're just barely growing faster than inflation, which to me is pretty incredible because, boy, they've added a lot of stores. You would think they would have just been growing with their store count, and yet their cash from operations is barely keeping up with inflation, even with all those new stores added. All right, so we'll talk about that. So you're not just looking at the CAGR, you're also looking at the trend. So if you look at Walmart, the trend is pretty flat. You notice 2013 is a pretty weak year. So if you did the growth from 2014, they essentially have not grown their cash flows any in the last 9 years. The exact same number. 2020 is really not entirely CAGR. There's something else strange going on there. So it's a little frustrating. So how do you figure out what's going on? So find your annual report. And find the financial statements, page 50. So here's their cash flow statement. So if you notice, like here, it went from 36 billion to 24 billion. So net income hardly changed at all. So there's something strange going on. That always makes you a little nervous. And you notice right here, there's an $8 billion adjustment. So you'd want to know what that is. You notice here, there's 11 billion for inventory. So the inventories had some issues. They bought a lot of inventory. So you want to figure out what that is. Do y'all know how realized gains and losses work? So this is good stuff for your CFA review. So let's say you sell an entity, you bought it for say 250 million and sell it for 300 million. So what's your gain? I'll take out the millions. So your gain is 50. All right, so what goes through net income? 250, 350, what goes in your net income? Yeah, plus 50. It's a realized gain. Where does the 300 go? They sold this thing for 300. It's not revenue. So if you sell an asset and it's not part of your operations, only the gain goes through. You don't show any revenue. You just show the net sell. Now, if they were in a business of selling that, that would go be revenue, but they're not in business of selling that. So in the cash flow statement, where does the 300 go? Investing cash flow. That's 300. So now we got a problem. We got $300 million. So the cash flow statement is showing 300. That's fine. That's cash. But net income shows a gain of 50 million. And that's in net income. So what do we have to do to that gain on the cash from operations? We have to show a minus 50. Right? Because the 300 includes the 250 we bought it for plus the gain. So the 300 is already in the cash flow statement under investing. But net income has an extra $50 million for the gain. So it's like we got 350 in there right now. So what do you do with that 50? We got to subtract it. So if you see a subtraction in cash from operations for a gain, that means they sold something for a gain and it's in net income. They're subtracting it back out. So what is Walmart doing? They must have sold something for a big gain. See how it says it over here? Gains, negative, losses are positive. Okay. So they're not doing this because there's a cash flow. They're doing it because there wasn't a cash flow that's got captured in net income. That makes sense? You have to know this for the CFA exam. It's really kind of critical. Their liabilities are about the same. Their payables are jumping around. Why did that drop down? You know, you got some pretty big jumps here. That big jump in inventory would be an interesting thing to look at. I think Walmart had some issues here of having too much inventory. I think Target as well. They did too much after COVID. So those kind of things to look at. Loss on extinguishment of debt. I don't know what that means. So, you know, you'd have to look some of these up. But this is the level, we see a big change. This is the level of detail that can help you try to find it, but it's not always easy. You can see there's several lines going on here. So we had a $12 billion drop, but this is a negative. So where's the other side of it? Here they have a loss. So they're the loss, they bring that back in. So you're trying to figure out why did it go from a positive 36 to only a positive 24, and then why did it jump up to 28 here? But the only way you can do that is to get this detail. And not every firm's going to have the same lines. And that's one reason why Yahoo Finance is so summarized, because they can't give you all this detail because they have to have a common template for the companies. So that's how you do. Just get the annual report. Now, what if it was something happened in 2017? You may be able to ignore it or just bring up their 2018. You need their 2018 financials so you can see 16, 17, 18 and see what happened in 17 to cause that big jump or big drop. And it's pretty easy to get annual statements back several years. So, all right. So something strange happened in 2020. It looks like it has something to do with a sale or transaction with a subsidiary, but who knows? Right. So CFO fairly flat. I said weak. You do have to pick your adjectives and adverbs in this section. To me, anything for a firm, y'all see my point? They've added, oh my word, how many stores have they added? Massive a number of stores. They've added 3%. No, I guess their store number count is flat, so I take that back. Their square feet is up about 1%. So you think their revenues would have grown inflation plus 1% just because they added 1% more square feet, and yet they're just barely getting any of that. So pretty weak. Now on net working capital requirement, let me explain how to do this. I used to do net working capital requirement as a percentage of cash from operations. But you see how volatile cash from operations is. So you got a lot of noise in this chart because of cash from operations, not because of net working requirement. Revenues is much more stable. And so I like to do it against revenues. It gives you really small fractions of percents, but that's okay because you're looking at the trend. Now tell me this, is this good or bad that it's going down? Is that positive for liquidity or negative for the liquidity? Positive, yeah. Lower is better. If you have a positive number, lower is better too. You just want the line going down. So their liquidity improved dramatically from 2013 to 2017. Why is that? Well, down at the bottom of print page 1, I give you all the accounts for working capital. So we just said there's a big change from 13 to 17. You could certainly go in here. Oh, I don't know what year it is. That's one thing I don't like about freeze frames. You can't see anything. So line 3, okay. So I've already forgotten 2000. So they went from a net working capital of 4.4 billion cash inflow to 13 billion. But look at their, you think it'd be inventories. That's their biggest item. What did inventories do? Pretty flat. So it's not inventory. Accounts receivable, very flat. Uh-oh, it's an other. That's a big one up there. Accounts payable. Why did our accounts payable go up $10 billion? That's kind of interesting, right? What is Walmart doing so that their accounts payable went from 37 billion to 47 billion dollars when their inventories was flat during that time? They're doing something great, but I don't know what it is. So accounts payable is the biggest part of that, but this other is going the other direction. So accounts payable is going the right direction, is helping them 10 billion. Current assets is going the wrong direction, hurting them by 3.4 billion. What's in that account? And this is where it gets really frustrating. You go to their balance sheet, you want to know what's in that other current assets. You go to other current assets, click on that, and there's 10 things listed, and the largest one is other. So you discover that the biggest item moving is other. Then you got to go to the footnotes and figure out what's in that number. That's the way it's going to be. It's just this is what you do in your job in secure analysis. You're like a detective. You're trying to figure out why did that number move. Now, supposedly, if a number changes a bunch, the accountants have to write about it. Any material change. So here, what you want to do is see where was the biggest material change. Maybe it was from this year to that year. And then go to that annual report and see if they say something. What I would do, say, okay, there's a pretty big jump there from 16 to 17 accounts payable. So I would go to the balance sheet, try to find that line, see what that account is called, And then I would do a search on that account to see if they have a footnote discussion of that. That's the way I do it. You know, so you're trying to drill down until you find exactly what you're looking for. Now, after that year, it dropped back down. Why did it drop back down? Well, that other current assets dropped back down. So there's something strange going on with other current assets. You might want to find what that is. If you look at the actual annual report on the balance sheet, their prepaid went up. Cash is not going to be there. I'm not seeing anything jumping out at me, but that's 22 to 23. Which one am I looking at? I may not have 20. I'm looking at 21, 22, so I may not have that in there. You know, I have to have the right years. So, I mean, look at that jump from 19 to 20. 18 billion. Where did that come from? Right there. Other current liabilities. What's in that? So they're not giving you much help. I don't have the right years here, so that's part of the problem. But other current liabilities, you see any big items here? Accrued, that's large. Their payables is pretty consistent. So I'm just looking through to see, was there anything major? So why did this go up $5 billion? It looks like it was accrued liabilities is the main thing. So then you say, well, let me do a search on accrued liabilities and see if they discuss why that went up $5 billion in this year. All right. How long could it take you to answer all these questions? Like 50, 60 hours. I'm not asking y'all to do that, but I would recommend at least once or twice try to drill down and figure out what's going on with your company. I'm usually, when I see something like that, I get so curious I can't help but go research it. I'm just so curious, and then I get into this kind of downward spiral where you finally just give up. And they stop writing in English and they're using Greek, and I'm just like, I can't follow you anymore. So I'm not asking you to explain every single bump and bounce around here, but one thing you'll realize with your boss, there's no way your boss is going to let that go. And you don't want to walk into your boss's office so you have no clue what that is. So in real life, you're going to have to research this. You never walk into your boss's office with an obvious bump on a chart that you can't answer, because it just makes you look like you're like, oh, wow, I don't know. That just sounds so bad. It's like so obvious. Wait, what happened here and here? And so you just have to be ready to answer that. All right. The next one we're going to look at is how they spend their cash. This is the free cash flow. Remember, when they have a free cash flow, they're paying dividends, they're buying back their stock, they're paying down debt. You have to be real careful with this chart. We'll get into it a little bit more next class. Be careful with this chart. Above the line is cash leaving the company, below the line is cash coming in. All right, so be real careful on that. So in 2008, they borrowed a lot of money to buy Flipkart. 2022, they borrowed a little bit of money that might be bad. It could just be a temporary thing that they did. Maybe they paid a special dividend or whatever. So who knows why that is. There's still net cash outflow because they bought so much of their, you look how much of their stock they're buying back. It's pretty dramatic, pretty significant amount. Their dividends are very, very, very constant every single year. And then the last thing we're going to look at is what they're doing with their CapEx. So I used to do CapEx as a percentage of CFO. And again, the CFO is just so volatile, you're not getting good answers. So I did as percentage of revenues. So the reason I asked that, and we'll get into it, is Walmart is sending a lot of cash out the door to its investors. Is that because they're producing a lot of free cash flow, or is that because they're cutting back on CapEx? And it looks like it's probably a little of both. They've cut back their CapEx quite dramatically. Here recently, they've invested more. Who knows what that is? So you might check on CapEx. And again, CapEx is in the cash flow statement. Look at cash flow for investing and just see there's property, plant, and equipment is. So the question is that new stores that they're building? Are they investing in new equipment? You know, what exactly is going on that's costing, $16 billion is a lot of money. So you're going to put all that together. So there's the three things you're going to talk about, and you're trying to cover it as closely as you can. Here's where business breakdown, you can put into paper 2, but you can also, you can comment some business breakdown you could put into paper 3, things that they're telling you about why these numbers are doing what they're doing. Right, so for Thursday's class, you need to have your company in Excel ready to go. I would recommend, once you get your data loaded, this Capital IQ data, you have formulas, Capital IQ formulas in there. I would recommend you select this, copy, and paste as values, and then save it with the word values in the title. That way, when you're working on it, Capital IQ won't keep updating every time you come in. All right. Once you get it final and you have it just like you want it, I would do this. Keep the other file with Capital IQ. Don't destroy that. So save it. You can see how I have it saved. Have it saved with the word values at the end of it. It won't show it, but I have the word values at the end. So I have one I call Capital IQ and one I call values. It's much easier to work with values. Here's where I was talking about at the bottom of here. Lines 48 and 49, there's your inventory and accounts receivable turnover. So you do have those ratios. And if you know Capital IQ, you can bring in other stuff as well. If you need to answer certain questions, especially if you find something in your report that says, wow, I really need that number. That's really critical. You could bring that in on the Capital IQ, resave it so you have the data. The data for graph buildings, we'll talk about this. This is where you can make some adjustments. We'll get into that. And this is where I do the industry stuff. And sometimes this messes up, especially at the 0.1%. So I'll show you some places where you'll want to delete some lines. All right. So I need all of you to have this file open when we do Walmart. All right. The other thing I recommend you do, we might have talked about this, but you see I have a chart that says graphs used for Walmart. We talked about that? Did we already? Okay. So create one for your company and make all your adjustments there. Don't mess up print page 2. So are there any of you that are going to send me your file for me to do that for you? If you're going to need to do that tomorrow afternoon is a perfect time for me to do that. I'll be up here. I can use the machine here and get it to you quickly. So what are you going to send me before I do that for you? The Russell 3000 file with all your companies selected. Huh?
Can I come tomorrow?
Yeah, if you want to come do it yourself, I've only found one machine that works in there, so you have to use that one. But or you can just come by and we can pull it together, and I'll already be logged in. We can just grab the data. In fact, you can see how Capital IQ works, but also get your data really fast, and we'll just email it to you. All right. So I want everybody here. So that means you also need your laptops. So it looks like all of you have your laptops. So you want your laptop with your firm loaded. You might get on the Zoom as well, because if you have a question, you could share your file and the whole class can look at it. All right. So log into the Zoom and all of that. All right. So get your data. Very, very important. All right. Questions on anything? Very good. All right. So Thursday night, very, very important night. So we're going to walk through liquidity for Walmart tonight and probably get through, definitely through solvency. So you've got 4 charts, 3 comments to make here. The first comment is real simple, just looking at the cash from operations and making a comment on whether it's growing or not. So with Walmart, we said it was pretty flat, kind of bouncy around here. We couldn't really explain that one. Working capital requirement, we said lower is better. So doing really, really well. And again, something wild happened here. It's been pretty flat the last few years, but it's a source because it's a negative number. So whether it's a source or a use, you want it coming down, that's better than going up. And then the next thing you're trying to do is figure out why. We talked about that last time. You know, was it accounts payable? Was it inventory? What's going on? And then looking at their cash flows, certainly Walmart's sending out $20 billion to their stock and bond holders, well, mainly stockholders. If you have a liquidity problem, you're not going to mail out $20 billion. And they've been doing that fairly consistently over time. Very, very stable dividends. A little bit volatile stock buybacks. Debt is kind of all over the place, but explainable. So strong cash flows, but why is that? Is that because they are producing free cash flow, or is it because they're cutting back on CapEx? CapEx had been falling pretty dramatically. So some of that extra cash is probably coming from not spending as much. This is percentage of revenue, so they could be building new stores, but it's not at the same rate they had been. The last few years, that's jumped up. Why that's the case? You could certainly in your paper try to figure that out. Go look at their CapEx and see if you can figure out if there's one particular thing that they're doing that's causing that to jump up. So I'm going to say Walmart is a very liquid company producing solid free cash flows just because they're paying so much to their investors and they've kept a fairly consistent 2 to 3% CapEx, and it has increased the last few years. So they're definitely a cash-rich organization. Now, what about cash-poor organizations? They're issuing a lot of stock, borrowing a lot of money. So it could be like a Netflix where they're doing so much of this production that they have to reinvest because they're, doing all these shows. I think the strike got resolved, didn't it, this week? So I can keep watching the shows I've been watching because it doesn't impact that, but it's definitely going to impact Netflix. It's probably going to cause them to spend a lot more money on shows. So there could be some impact there. So you're essentially just looking at this firm. Are they producing cash that they're sending out to the investors? Are they producing cash that they're reinvesting in the firm? Or is it neither? This is just not a cash-rich organization. There are some very capital-intensive firms that have to spend a lot of money just keeping things going, not the best business model. So questions on liquidity. Any of y'all have charts that are particularly, so we might even just, I want to try this. Someone have a chart you want to share just to see if the sharing will work? Any of y'all's charts, like your chart 2, anybody have a weird chart 2? So you should be able to share. Anybody want to volunteer just to see if it works? No? No takers? All right. Liquidity is usually the hardest part of the analysis. Not,
Sure.
all right.
I have the drawing.
Yeah, actually share it. I just want to see if it worked. I think it's pretty cool. I mean, this is new technology from the last 20 years. Part of the problem is that it does somewhat contradict what you learn in your accounting classes. So you still got to get beyond this concept that working capital assets are good things. We don't think of them as good things. Oh, one. No, you're not sharing, are you?
Not yet.
You must have just made some noise. Are you trying to share, Don? Oh, join the Zoom. Okay. All right. Yeah, you have to join the Zoom to be able to. It's linked on the Canvas. So he's sharing the Excel. So you have your print page 2. So go to your print page 2. So you notice this chart 1 doesn't show up. And why is that? Because that's built for Walmart. So you want to essentially create your own charts for your company. So go to your print page 2 and well, we can stay here. I'll go back to print page 1, sorry. So their net working capital requirement is a negative number. So it's a source. That's pretty amazing. It's become less of a source. So they're not as liquid as they used to be. It has been as high as 4% of revenues. Now it's down to 3%. So they're getting worse. Let's find, so the big change from 2020, 2022. So go down to the bottom of the page. Let's see if we can figure out what happened between 20 and 2022. Coming down, very, very bottom. So in 2020, it was the same number. So it must be that revenues came down, right? Your working capital really didn't change all that much. So why did the ratio change? What did your revenues do between 2020 and 2022? Did they actually drop? Did you have like a COVID bump? No. Oh, because it's a negative number. So Yeah, so what's happening with, okay, so this is interesting. So for Chipotle, their net working capital was a source. You'd like it to grow, but it didn't. It's exactly flat, and yet their revenues grew a bunch. So why didn't they become more liquid as they grew their revenues? So Dante, you have to figure that out. So it's just flat, nothing's changed. So the biggest issue for you is inventory. So go down and look at your inventories and see if they grew at all. No, your inventory is just, what is your accounts receivable for Chipotle? What accounts receivable does Chipotle have?
I think the others are active. And
Yeah, that jumped, so that's gonna hurt you, but then your payables jumped as well. Now, one thing you have, I'm not sure about him, so your net working capital is like $200 million and what's your net income? Or your cash from operations, go back up to the top, sorry. 1.3 billion. So there are some of your firms, you might just say, you can almost ignore it because it's just such a small number. It's just so small, it's well managed. So that I think his is a little more material number than that. So his big issue is why didn't the working capital requirement source grow as fast as revenues, and it's just not growing that fast. Yeah, interesting. So it's gonna be a little difficult to talk about because it's just a flat number when the business is growing really fast. All right. So yeah, how do you stop sharing? Stop persistent sharing. Okay. All right. So it does work. So if you want to potentially show your file, jump in. Just raise your hand. Tell me you want to share something. Now, I said his may not be material, but yours is a larger percentage of revenues than Walmart's is. So you're even more of a source than Walmart is. Walmart is averaging 1 to 2%, and you're averaging 2 to 3, right? For most part. So you even have more liquidity in Walmart, which is pretty impressive. All right, let's talk about solvency then. So I'm gonna go back to the class notes. Let's talk. Solvency is usually pretty simple. There's two parts that we look at solvency. One is your ability to pay, and the second one is your level of debt. So ability to pay, you call those coverage ratios or times interest earned. Your amount of debt are things like debt to equity, debt to EBITDA, those types. So we're going to use two different ratios. The first ratio we're going to use is times interest earned. So times interest earned is your earnings over your interest expense. Essentially, you're asking how much extra income do they have so that they don't default on the debt. Higher is better. Here, I'll actually give you some rules of thumb. And here the rules of thumb are above 10, it's just not an issue at all. So if your firm's above 10, you don't really care. Like if it's, let's say it was 35 and it dropped to 30, you don't really care. It's above 10, you're strong. If it was 50, dropped to 40, not a big deal. Now it was 15 and dropped to 8, then you've got a concern. You used to be strong and now you're getting weaker. If you're between 2 and 10, it's something to watch out for. It may not be a serious issue, but I'd watch out for it. That's where the trend becomes important, because if there are 7, then now they're 5 or 4, now you're getting into dangerous territory. 2 is generally considered a weak number. If you fall below 2, you've got some issues, okay? So we'll get to Walmart. If you have a negative number, you don't even show the chart. What does a negative number mean? A negative number means they have more interest income than interest expense. So it's obviously not an issue. An Apple might be in that category. I have $200 billion in cash and $100 billion in debt. They may have more interest income than interest expense. So if you have a negative number, do not show the chart. Let me show you the Excel for Walmart. All right, so here's their times interest earned. The first thing you're probably going to do is delete the 0.10 and the 0.9. All right, that's one chart you almost always delete, the 0.1 and 0.9. We look at Walmart, they're right in line with the industry and they're well above 10. And they've gotten stronger recently, but I'm just going to say not a concern. They're well above 10 and they're consistently in line with the industry. not an issue at all. How many of y'all have a negative number? Anybody doing Lululemon? Yeah, so you don't even show the chart 5. There's no reason to show. You can show your chart 6, and we'll talk about that a little bit. Anybody below 10? Or you're negative, so you won't even show chart 5. You'll just leave it completely out. I think Chipotle has some debt. Lululemon doesn't have debt. Oh, and okay, so we talked about yours, Dante, right? You don't have debt, you have capital leases. Capital leases don't go through interest expense, so you can even say that times interest earned. You can say something like times interest earned is not applicable to Chipotle. While they do show debt, the debt is actual capital leases that don't go through interest expense. And so you just leave it like that. All right. Who else has a negative number? You do? Yeah, so just don't show. Is it negative every year? All right. So if you have a couple years negative, I'll show you how you can handle that. All right. Anybody have that? Maybe I'll wait until we have that issue. Anybody have like 2 years that are negative? Boing. All right. Oh, that's right. We saw I think I showed you how to do that, right? All right. So if you have a couple years that are negative, over here you have this page that says data for graph building. So let me show you. If you have something that looks like this, y'all see that? 1 year this looks crazy like that. So what you can do is go to data for graph building and just find that number and just hit the delete key. So you get a graph that looks like this, and that graph is perfectly fine. Okay. Especially if it's several years ago. So if it's like 2013, 2014, that was yours, right? Going, your first few years are all negative. So you just delete those years and his line will just start kind of midway. All right. So this is perfectly fine. The only time this doesn't work too well is if 2022 is the only number you delete. Then you're just missing the most current year. You can still do it. It just looks a little weird. Okay. So that's data for graph building, and the graphs are numbered. And so, yeah, you just take that 1 point out. That's also true if you have a really, really high number. So if you have like 333 and then 8,000, 333, just take the 8,000 out and just give yourself a straight line. I mean, good line going across. All right, questions on that? Easy way to fix that. If you have all negatives, just don't even show the graph and just say not applicable for your company.
Otherwise, you just delete that year if it's negative and the others.
Yeah, delete the year, but be careful how you delete it. So you just want to hit the delete key on that one thing. Never delete rows or columns. Yes, but yeah, just hit delete on that 1 year, whether it's a really high number or a negative number. I was tempted on that one. And Capital IQ is a little tricky. You can show interest expense where it's only interest expense, doesn't include the interest income, and that gets rid of the negatives. But you really want to see, I mean, if their net interest they're getting more than they're paying, times interest is not an issue. You just kick out the chart entirely and just ignore it. Right. So the second thing is, how much debt do they have? Debt to equity is probably what you had in your accounting classes. Debt to equity, man, it seems like we talked about this because I have another class that's doing a similar thing. And so if I'm 60 years old. So me and my brothers get together and we tell the same story 6 times in a row and we don't know it. So it's just old age. So if I start telling you stuff that I've already talked about, just say you already covered that. So debt to equity, I don't like. It's not used in the industry much. It doesn't make sense. If you're buying a house, they're not going to ask you for your net worth. They're going to look at your debt versus your income. It's just a normal thing to do. It makes the most sense. The same thing with companies. How much debt do you have versus your income, not debt versus your net worth, all right? So this is the more common one, debt to EBIT or debt to EBITDA. I can't remember which one I used, but we'll look and see. So how much debt do you have versus your earnings? And there, what you're looking for is how they are versus the industry. There's really no standard because every industry is different. Utilities, that number is going to be really high. For tech companies, a 0 is pretty common. A lot of tech companies have no debt at all. All right. So in this case, we look at Walmart. Again, if you have a bunch of companies on the zero line, just take those out, all right? You don't need that. I would take out the 90th percentile unless your firm is in that 90th percentile and you want to show that they're really high. But this is another chart, you'll probably only show the median in your company. And there for Walmart, they've been in line with the industry. Now they're below the industry, but very much in line. Doesn't look like they're carrying excessive amounts of debt. Looks pretty reasonable. Now, if I was doing a financial services company, well, it kind of depends on if they use debt or deposits. You can get some pretty radically different answers. Now, Lululemon, I would probably just leave out chart 6 as well. If it's just all zeros, no reason to show it and just say they don't have debt. So obviously they don't have too much debt. Yeah, higher is typically you're going to say that's worse. Yeah, you want to be in line with the industry or a little lower. You know, technically having zero debt, you're not maximizing the value of the firm. A lot of firms that are growing fast, they don't want debt because they don't want their debt holders putting covenants on top of them. But, you know, from a maximization, because interest expense is tax deductible, yeah, you get more value using debt, but some firms just don't like, fast growing firms a lot of times don't like using debt. All right, anybody have unusual looking chart 6? Now, if you have a bunch of zeros, you could probably leave the zeros in there if it jumps up at some point. So yours jumps up, and I think Chipotle jumps up because the accounting change, where capital leases went from being operating leases to being capital leases. So you used to have operating leases, and they essentially changed the rules, so everything's a capital lease. So that's probably, I don't know if we're 100% sure. You could find it out by going back to their annual report on the year that it flipped and see if they talk about it in annual report. But because I doubt they radically changed how they do leases all of a sudden. I think it's the accounting for leases. So you'd have to talk about your chart 6. You're going to talk about the fact that this is not really debt, it's capital leases, but now it's classified as debt, and that's what their debt is. Does it kick them above the industry or in line with the industry?
So it's like flat at 0 and at 29
Slightly below, yeah. So it's capital leases are debt. I mean, you're signing a contract to pay rent for however long period of time. So it looks a lot like that. It's a fixed payment for a long. It may not be even fixed payment because a lot of these retail operations they pay a fixed amount plus some percentage of revenue or something. So, but it looks a lot like debt. All right, so that's essentially it for solvency. Pretty straightforward. So I'm going to say Walmart has been strong, above 20, not a serious issue, well above 10. I actually put the 10 into the conversation. If you're between 2 and 10, look at the trend and say, yeah, it's concerning, it's below 10. However, they've improved the last few years, or has been consistently above 10, but recently it's fallen below 10. We need to watch this carefully. It looks like debt may be becoming an issue. Those are the kind of comments you're going to make to put it into the context. As far as the level of debt, they're right in line with the industry and actually come down below as the industry is shot up. So their total debt, we see the ratio has been very stable over time, and now it's below the industry.
Would you want us to keep chart 6 out as well if it's not as strong? Deere's that EBITDA is massively above the industry average.
If it's a ridiculously high number, so it depends on how high it is. Can you share it, or are you on? Yeah, I mean, I'd have to see it. So it depends. If it's the industry's at 3 and they're at 120, then yeah, you can't show it. But if the industry's at 3 and they're at 7, then you can show it.
It's not that massive. It's industry's around 2 to 3, and they're at like 9.
Yeah, I would show it. I mean, that's a pretty high level. Yeah, you want to show it an extreme. Sometimes they can be extreme 1 year, not because their debt's high, but just because their earnings, you know, they had a recession or something. You know, 2020 couldn't have been a really bad year for them because of 2020 COVID. In that case, I might just kick 2020 out. So you're trying to measure the amount of debt, but you're doing it to EBITDA, which is pretty volatile numbers. So some of the noise can be earnings, some of it can be debt. So if their debt's not all that volatile, but their earnings are, then the chart's kind of giving you a mixed picture. So if you have one number that's really bad, take it out. But yeah, if they're 9 versus 3, I would show that chart. When you know it looks bad is when they're so high that the industry looks like they're on 0. when they're really not on zero, they're on 2 or 3 just because it's just so high. I remember our real estate company did this. They showed a chart. And they want to say, yeah, it's really not an issue. It's like, wait a minute, guys, you change your axis. So, I mean, give me a break. So don't do that. All right. So they look in line. So that essentially finishes solvency there. All right. It's just those 2 things. And I have one more thing to come that's not really solvency. It's really liquidity and solvency combined. Any comments on solvency, times interest earned, level of debt, pretty straightforward. These are 2 that you really need to do versus the industry because they are very industry specific. And it's places where you can leave the chart out entirely if you need to. All right, so the last thing we're going to do is do an assessment of liquidity and solvency. We're going to summarize this short-term viability section. And the first thing I want to do is that thing, that book I showed you, Financial Shenanigans. I want to take his book and look at one thing he talked about is if they're playing with the books, you're probably going to see a disconnect between net income and cash from operations. So why don't we just graph those 2 things? And so this is a chart. I really like this chart. The total chart is cash from operations. When you add all the beams together, it's cash from operations. The blue is net income. So what you're hoping for is a firm that the total chart is bigger than the blue. So whatever they're doing with net income, it's actually reducing them versus CFO. So things like depreciation, right? Their net income's lower because they're doing depreciation. That's non-cash, so you add it back to cash from operations. So if you look at Walmart, depreciation, we just add a constant number back every year. Then you have the working capital. Working capital can be positive and negative some years, but if they're playing with the books, you're going to notice net working capital being a negative and getting a bigger negative. That's a concern. All right. If they have fictitious revenues, they're going to have a receivable that's just growing, and that's going to be below the line. That's going to be reducing your CFO, right? Because your income's going to be higher because you have this bogus revenue, but since you haven't collected it yet, it's going to reduce your CFO. So what you're really worried about is not the green that's kind of up and down, sometimes positive, sometimes negative. What you're really worried about is the green is consistently negative for several years and it's getting more so, because that means inventory or receivables, something's being abused. Walmart, it looks like these are pretty normal fluctuations. And then the last one you have is other. Other is the one that can be interesting. So we saw with Walmart, it can be that realized gain or loss. You might look, if you have an other number, now if it's an other number that was huge back in 2016, you could probably ignore it. But if it's huge the last couple of years, I'm curious, what's going on with cash from operations? That's not working capital, not depreciation, that's causing a big hit to their CFO. I want to know what that is. So go and look. It can't be dividends, right? Because dividends goes through through financing activities. So it could be a pension payment. It could be one of those realized gains or losses. What else could it be? It could be the Netflix. I can't remember who's doing Netflix in here, but it could be the Netflix one where they're doing their production. They're counting that as a CFO, not as an income. That's a pretty big one for Netflix, and it's probably fixed over the chart. And I think that's all in the blue. Yeah, are any of y'all see any wild things going on with this chart? Most of you are going to say, I don't see anything out of the ordinary. Some students are going to say that when there's something definitely out of the ordinary. So don't just say that, copy the Walmart language and just ignore the chart. If you see something massive happening, on Walmart, I would probably go check these 2. I think they are realized a lot of gains, I think, realized losses probably that they're adding back to CFO. So no one's seen anything wild there. There's usually at least one that's pretty wild. Are your working capital requirements positive, negative, kind of blunt? They should be bouncing around a little bit. It's unusual for firms to be fixed. Now, Allison, working capital may be an issue for you. A lot of real estate companies don't have working capital at all. So I'm not sure you're seeing 0 there. So your chart 2 might be an issue. So we may have to talk. You may have to do some. So I don't know how your chart 2 looks. So you may have to come meet with me. We have to figure out some way to put that in there because they don't usually have inventory, and receivables is kind of strange. So All right, I put the deferred tax in there, but you can see for Walmart, it didn't really show up, so it's not really an issue. And then the last thing we're gonna do, so here we're just saying, hey, does it look like they may be cooking the books? And I don't see any major trend I'm worried about. And then the final conclusion is you just state, and here's where students lose some points, because all they do is change the name of their company. And they don't change any of the other words. Make sure whatever you say here applies to your company, okay? So Walmart is very liquid. They look strong. They're doing well. Their working capital requirements has improved and it's pretty stable here recently. It doesn't look like they're doing too much debt. That may not apply to your company at all. So make sure you say what it says to your company. So like Lululemon, this is a liquid company. Liquidity has declined recently, but they don't have any debt, so that's not an issue. I think with Lululemon, the reason their working capital is declining, I think it's because they're growing so fast, and well, it's really more turnover. When we hit the turnover, we're going to see that impact. Sometimes faster growing companies, they'll build up inventory, and you'll see Lululemon building up inventory because they're growing faster, trying to get ahead of that curve and trying to issue new clothing lines, those type of things. And then my final thing I do on this is credit ratings. I'm pretty sure S&P and Moody's have done more work on this company than I have. They don't have that many companies to monitor, and they spend a lot of time on them. They talk to management, they interview them. If I think Walmart is wonderful, but the agencies rate them as double B, then I probably have some error in my analysis. So I think Walmart's wonderful, and they're rated double A. Double A is a tremendously good rating, right? Where do you get the ratings? I think I put the rating definitions out there, didn't I? Under files for papers. Oh, I didn't. I have to give y'all the rating definitions. They might be in the notes. I can't remember where I put them, but let's see if they're in the notes by any chance. Nope. All right, I'll give you the rating definitions. So double A is very, very high. There's no triple A's in this room. Exxon isn't even triple A anymore. So even if someone had stuck with Exxon, that would have been there. Triple B is pretty good. Don't freak out with triple B. I think triple B, they use the word adequate. So triple A is very, very extremely strong capacity. Double A is very strong. Single A is strong. I think triple B is adequate. And then when you get down to double B, that's below investment grade. That's junk bond. That generally is, they use the word vulnerable, which I can't pronounce, vulnerable. So it doesn't mean they're about to go under, but it does mean a serious economic crisis, they could be in trouble. So they're probably less. Double B companies only go insolvent about 5% of the time over 10 years. So 95% of them are going to survive. So it's not that serious. Are any of y'all below any double B's in here? Because I think most of y'all are. Yeah, we'll talk about that. If you don't have a rating, you'll have to delete this section here. You'll just say Lululemon doesn't have a rating. However, they do have a Bloomberg probability of default, and you'll just have to talk to that. And we'll talk about that probability of default. How many triple B's do we have? That should be the majority of you. Oh, because they don't have debt. Yeah, so you'll just have to use their Bloomberg. All right. So if you don't have a rating, well, even if you do, but if you don't, you'll especially be relying on this. I love this Bloomberg probability of default. I did a regression between it and credit ratings, and it's pretty decent. There's a good correlation between what they're doing. Now, if you don't have this rating, you could go to Bloomberg, and if you type your company, Lulu, you hit the function 8 key and then type CRPR. It will bring up all of the ratings, and one of them will be this Bloomberg. And if you click on that, they'll give you a lot more information. They'll actually tell you what this equates to. So they have investment grade 1, investment grade 2, high yield 1. They'll actually tell you, and they'll show it over time. So if you want a chart, like you say, I just want to have a little extra in there, you could definitely go on the Bloomberg and get that. You can't get it out of Capital IQ because this is a Bloomberg only. But if you go on Bloomberg and you type that, click on the Bloomberg, you'll see all kinds of charts that will come up, and it's pretty helpful. I'm using the 5-year probability of default, so you'd have to click on that one. They have other time periods, but the 5-year period probability of default. Now in this one, I left the 90% in there, but you might take it out if it's really distorting the chart. I like keeping the 10 in here because it shows where Walmart is. They're better than the 0.1. All right. And Geronimo, you're doing Costco?
Yes.
Yeah, so they're in that same league, right? And they're single A, aren't they? They're not double A, I don't think.
No, yeah, that's the way.
They're double A. And y'all know where the ratings are? Have y'all figured that out? On print page 1 at the very, very bottom. So you click down there, so you can ignore the 2s and the pluses. Well, put it in the paper. So if it's double A plus, put double A plus, but the definitions, you don't need the pluses and minus, you just use the definition. So my final conclusion is they're strong and the ratings EZC, or at least Bloomberg agrees with me. I think Lululemon is pretty low on this chart. They look pretty strong. So I doubt many of y'all are too weak there. Sometimes, Jay, a firm like yours can get dinged by Bloomberg. So it's possible you have better ratings. My guess is you're probably a triple B firm.
Just a quick Google search, double A plus, but then, Cadillac is.
Double A plus. Boy, that seems too high to me. And it's right here. It's double A plus.
Yeah, it doesn't show,
So one thing you can do, if you Google, remind me your firm again, I can never remember. Old Dominion. You can actually Google it. And it will often come up. That's Weiss. You don't want Weiss. So a lot of times it will come up. Now you don't want analyst ratings. So all they're showing here is Weiss. You're not showing S&P. So I'm not sure. So you might do what I was telling her to do on Lululemon is go to the Bloomberg machine and do that CRPR and see what they actually give you. But it should have brought in the right number. So, just look at it just to make sure.
Yeah, their total debt is so low.
Yeah, they may not actually be rated. So if you're not sure about that, leave it out. And how does the default look though? Because I'm worried they look high on that.
Their probability is 0.11.
Okay, that's really low. Okay, so they're doing something right. I'm not sure what all. The wonderful thing about this ratio is you can actually get the ratio. Bloomberg will actually walk you through the entire ratio. So if you need kind of a substitute for credit rating agencies, you could build your own model and use Bloomberg. All right, questions on short-term viability. Most of your firms are not going to be an issue. Most of your firms are pretty solid, stable firms. Does Copart have a rating, Jojo? Let me check. So you need your data still, so we got to get your data. They're probably pretty highly rated, just given their strength. I'm sure they must use debt, the kind of model they have. All right. So let's get into my favorite topic. Let's talk about activity ratios. So activity ratio is all about revenue and revenue growth. So what we're asking with an activity ratio is how much effort are they putting in to getting revenues to grow? And there's a lot of different ways we can look at it. I'll give y'all some ideas here. But asset turnover is just revenue over assets. So if you grow your revenues 10%, but your assets grow 15%, you're not doing all that well. You got to put a lot of assets into play just to get 10% growth. So what you want is your revenues grow faster than your assets. That you're getting more revenue out of existing assets. Anytime you see the word turnover, you're talking about revenue. In fact, it's strange. I listen to The Economist every week. And these are the British, and I probably told you all this before, but they use the word turnover for revenues. So they don't use that as a ratio. So it's strange to my ear. And economists say their turnover is $20 billion. Like, no, their turnover is 7 times, 2.3 times. It's not $20 billion. So, I mean, they use it interchangeably. So I don't know the history of the word turnover. They don't use the word revenue at all in The Economist. So I use turnover as a ratio. It's some measure of revenue over some measure of how you got that revenue. Okay, it's output over input. So receivables turnover, remember that was a big part of your liquidity. It's a turnover. So when you improve turnover, you're usually improving liquidity. So receivable turnover is sales over accounts receivable. Higher is better with turnover ratios. So you're just asking the question of, you know, if my sales are growing 10%, but my receivables are growing 15%, what's going on? Am I collecting stuff more slowly? Do I have some bad IOUs out there? What's my problem there? And then the average collection period, you could calculate, you just take that receivables turnover and divide it into 365. So 365 divided by that. Lower is better here. So it's supposedly how long it takes you to collect from your customers. So if you get an answer of 10, then it's saying on average you collect from your customers over 10 days. This ratio would not make any sense for Walmart because they're just, you know, most of us don't owe Walmart money. So it'd be a really small number. If receivables is a big number for you, I forget what company I was looking at that had a huge, was that Visa? Who was it that had a big receivables number? It was really strange. I wasn't expecting it for that firm. So it's possible. I gave you, remember, in Capital IQ, the very last line on the Capital IQ data, you've got our second to last lines, inventory turnover and accounts receivable turnover. I gave you those numbers. You can see for Walmart, it's a massive number. Why? Well, because they have huge sales and very small receivables. So it just doesn't make any sense. It's not taking them 75 days to collect their no, it's not a ratio that makes sense for them. But inventory turn could be a really good number for a lot of you. You can see with Walmart. I'm sorry, this is the turnover. This is not the days in. So if I want to do days in, I would take 365 and divide it by the 820. So they've gone from 42 days to 44 days on the inventory. So their inventory is sitting there longer. If I want to do receivable turn, so I was thinking backwards on Walmart. It's a really small number because they don't really have receivables. So it takes, on average, or I guess you could say their inventory on average sits in the warehouse and in the store for about 45 days. That's possible. That doesn't seem unreasonable. I mean, hopefully the groceries aren't doing that, but everything else, TVs, computers, those kind of things, yeah, clothing, 45 days doesn't seem unreasonable. Right? So 365 divided by that number gives you the days in. On inventory turn, you don't use revenue, you use cost of goods sold. And again, higher is better, and days sales and inventory. Then we just have the basic asset turnover. I don't know where I have that ratio. All right, so asset turnover is just sales divided by assets. That's one of the ratios you're going to use. We'll look at it. Pretty straightforward. There, the question is, what are your assets? So like Lululemon, their asset turnover is really dwindled. Part of it is because their inventories have grown, but also their property, plant, and equipment, their assets in total have grown. And it looks like they've added quite a few stores. So they're adding a lot of assets. Their revenues are growing really fast, but their assets are growing faster. So they look pretty bad on that ratio. It's about one of the few bad ratios they have. It's not bad. They're better than the industry, but they're coming down much closer to the industry. So the question there is, what is their assets? Well, inventory is a big one. Inventories are like a fourth of their assets, so, and that's growing fast. But what's the rest of it? Is it their actual stores? Or is there anything else going on in there? So you kind of want to ask what those numbers are. Now for other companies, you're going to look at different ratios. So I gave you 4 ratios. If you go back and look at your file on print page 1, on lines 34 through 41, I gave you 4 ratios. I gave you revenue per square foot, revenue per employee, revenue per property, plant, and equipment, and revenue per store. Some of you may have a bunch of NAs on 4 of those because you don't have stores, you don't have square feet. So you just hide those lines and not worry. Don't delete the lines, but hide those lines. Don't worry about them. If you're a retailer like Costco or Chipotle, if you have square feet, use it, but if not, use number of stores. All right. For Costco, I would probably do revenue per store, mainly because their stores are all about the same size. This doesn't matter that much. Same like Dollar General, their stores look like they're all exactly the same. Is Dollar General having problems? Their stock price fell dramatically. And I rode by Dollar General today and like their windows have plywood in the windows. I don't know if they're having struggles, but their stock is down a bunch. But yeah. But revenue per store worked well. Walmart, I like to use revenue per square foot because they do have different size stores. They have those super Walmarts, they have the kind of the neighborhood Walmart. So store may not give me the same answer as square feet. Now, for a lot of companies, revenue per employee is kind of what you're stuck with because you don't have much else to work with. So USAA, we use revenue per employee. It worked really well at USAA. Most financial services are Accenture, consulting firms, revenue per employee makes a lot of sense. None of you are doing Nike, I don't think, or Adidas. So some firms like Nike, Adidas, you can do revenue per marketing spend, advertising. And that works really, really well just to show how much revenue you're getting for that advertising dollar. So you can pick numbers from the income statement, you can pick numbers from the balance sheet, or you can pick numbers that are neither one, like employees. All right. You got to find one. So for a Lululemon, I would probably do revenue per store if they sell 70-80% through stores. If they sell 90% online, then that's not going to work too well. So you'd have to ask that question. So for Apple, revenue per store, Apple sells a lot through Best Buy, don't they? So that wouldn't even count. So I don't know if revenue per store makes a lot of sense. Revenue per store for Microsoft would make no sense. I don't think Microsoft sells anything in their stores. So that would not make sense. So, Amazon, revenue per store doesn't make a lot of sense. Yeah, they have Whole Foods, but most of theirs is online. So for an Amazon, I would probably do revenue per employee, but that's kind of a strange one. So Luis, we talked about with yours, revenue per research and development costs. That would work well. I don't have R&D in there, so you have to find, did you get Capital IQ to work?
Yeah, kind of, but I went to a lab.
Not working. I can't get the machine you had working to work again. So it worked for me and then it stopped working. So if you go to Capital IQ, you could do a search and bring R&D in. So how do you do that? You go find the account, put it there, and then you just copy the formula down. And you copy it across, and then you have it, and you can calculate your own. You just do revenue divided by that number. So type R&D, type the word research. Capital IQ has a good search function, and you type the word research, you'll see all the accounts come in there. What else could you do? No one's doing Carnival Cruise Line, but Carnival Cruise Line, I'd probably do revenue per berth or cabin. If you're doing a hospital, I do revenue per bed. What else do you have? I'm trying to think of all your companies. Copart, I'd probably do revenue per employee, but I can't think of what else. I'm not really sure on Copart. That's going to be a tough one, but if you're not sure, use revenue per employee because that's kind of your fallback. There's some firms that doesn't work no matter what you do. So there's Disney. No one's doing Disney, I don't think. Disney, there's just not a good ratio. So we usually use revenue per employee, but that makes no sense. They look horrible revenue per employee because of the theme parks and the cruise lines. So it just doesn't work. At McDonald's, revenue per employee, what are the employees? They're franchise. Are they counting the workers in the stores or not? So you'd have to know that. You can't compare a franchise to a non-franchise on revenue per employees if one's not counting all those employees. Like Uber, revenue per employee. What does that even mean? Those aren't their employees, or are they? So that's what you have to figure out. Are they counting those as their employees or not? So I think McDonald's actually counts the employees in the McDonald's stores, when they bring it in capital IQ, I think those numbers are actually in there because it's a massive number, like 1 million people. So I don't think they have 1 million people working in their headquarters. Anybody have a company you're not sure what to use? Real estate, a lot of times with real estate, well, I'll have to talk. You can do per employee. Real estate is a different animal. I mean, there's going to be a few places paper 3 is going to be a little challenge. Usually what we do in real estate, and I'd let you get away with this, is what you really want is your revenue divided by your property values. So it's not really a turnover ratio, it's kind of the flip, it's a yield. How much, so your income over your property. So you'd have to go to Capital IQ and try to find property values. Yeah, the manage, if you can find something with the word manage in it, that would probably do it. Assets under management. So you don't want their home office, you want property that they're actually equity real estate. So whatever Capital IQ calls it, your word manage would probably be, that's a smart way to look it up, assets under management. They may call it that. So you'll probably flip it and do their income yield on their properties. And you want that going up. All right, so UPS is one I would probably do. So let's look at UPS. They're the easiest ticker of all. So here's one where you look at property, plant, and equipment and see that that's over half their assets. I would go with revenue per property, plant, and equipment. Works really, really well. So that's perfect for yours. Some of y'all might work. So Jay, revenue per property, plant, and equipment. If it's, I thought we saw that it wasn't as big as we were thinking though, so that may not work as well. So that will work. I can't remember some of y'all's companies. You're going to do revenue per store, more than likely. What are you doing? Okay, yeah, revenue per store work. What are you doing, Derek? I can't remember. Yeah. Oh, Qualcomm. Do they have fabrication plants? Let's see. How do you do Qualcomm? Is it QQualcomm? Yeah, not a very big. So I would probably go with revenue per employee. Like an NVIDIA, definitely revenue per employee. They got these scientists, you know, that's their revenue, are the scientists creating these products. Any others? So y'all do have a few unique ones. All right, so let's talk one issue here. So let's say your revenues grow 7%. And your square feet grows 3%. And your revenue per square feet grows 4%. Grade, I'd probably give them B plus, A minus. Why? They are growing the business, so they are adding capacity, but they are also getting more efficient, getting more revenue out of existing assets. So that's good. All right. What about this? Square feet grows 6%, revenue per square foot grows 1%. Here you say most revenue growth is added capacity. About the only way they're getting more revenue growth is by building more stores. That's a really hard way to get revenue growth. And here what we're going to say is not even keeping up with inflation. So what's inflation been? Probably about 2%. I still need to go out and get the actual number, but it's probably been around 2%. Even with 2022, it's probably been around 2%, maybe 2.5. So if you're below 2.5, they're all they're doing is adding stores and increasing their prices with inflation. They're not getting any more traffic. So no increase foot traffic. About this one. Well, some students get stuck on the fact that capacity is growing faster than the turnover, but that's not a problem. It's not like negative. So they're adding a lot of capacity, but they are getting more efficient. 4% is a good number. It's well above inflation. All right. But I get students saying, oh, it's bad because 4% is less than 5. You don't need to compare those two numbers. All right. One's just how much are they adding in new stores. The other one is how much are they getting out of existing stores. All right. You'll see that. Don't compare those. You don't need to. The only way you compare them is you want to say most of the growth is coming from capacity, but are getting more efficient. So yeah, it's true, more growth coming from capacity, but they're still doing a good job getting more revenue out of existing capacity. So here, better inflation. So that's good. I mean, they must be getting more store traffic, or they're raising their prices more than inflation. So that's a good thing. What about this? That could be good. So they appear to be trimming inefficient assets. That's good. If you're gonna, when you think about Albertsons, if I were Albertsons, I would list all of my stores revenue per square foot, and I would close the ones with the lowest revenue per square foot. Just like shut them down, because the margins are probably the same in all the business. The only difference is about revenue per square foot. If you're not getting good revenue per square foot, shut the store down, get rid of the lease, or sell the land, do something. So here, you know, that comment on capacity kind of applies to both. They're trimming the inefficient assets, and so they are getting better with the revenue per square foot. That's a good job. Now, if I did Sears, I would probably have square foot growth negative 30% and revenue per square foot negative 40%. I don't know. I haven't been in a Sears in so long. I'm always tempted to go to Sears just for the historical, just to walk in and see. Is there still, does Ingram also have a Sears? I don't know if there's any around. Kmart. I grew up on Kmart. There's one around the street. So that's just a business going out of a store going out of business. So, all right. Now, let's do PP and E. PP and E grew 4%, and revenue per PP and E rose 2%. So we gotta be careful here is do not say anything about inflation. You can't say they're not keeping up with inflation. So why is that? Revenue square feet, your denominator is in dollars, numerators, no, your numerator is in dollars and denominator is in a non-dollar thing. Revenue per PP&E, they're both in dollars. So inflation hits PP&E, inflation hits revenue. So if you're doing dollars to dollars, you can't say they're not keeping up with inflation because they're both in dollars. So the only time you talk about inflation, if you're doing revenue per employee, revenue per store, revenue per square feet. Okay, but if you're doing revenue per dollars of any kind, then you don't talk inflation. That makes sense? Everybody see how that works? All right.
So, I think one of the commentary is like saying that the revenue for like
Yeah, if the growth rates are different, that's really not an issue. So here, they're adding more assets. Might be interesting to see what they're adding. But at least the assets they have are getting more efficient. They're getting 2%. That number is good if it's above zero. Because you really expect it, since they're both in dollars, essentially just be zero. You grow your revenues 5%, you grow your PP&E 5%, and your revenue per PP&E just stays constant. You would expect most firms to stay constant. That 2% is actually a pretty decent number. You don't say anything about it being above or below. They're just getting more efficient. Anything positive is good. So then you have to think about, how do they improve this number? Is it marketing? What are these other things they can do? So you're looking at what they're spending on. So I'll give you some other options here. We talked, I wish maybe no one's doing Netflix and I just keep bringing it up. Firms like Netflix, you can do it revenue per user or per paid subscriber or something like that. It can be a little tricky because everybody's paying, so it's going to be kind of a fixed number. What we did with Meta, I don't think anybody's doing Meta. With Meta, you can do revenue per weekly user, because that's how their advertisers look at it, right? Because they're making advertising dollars. Their advertisers want to know how many active users. They want to know active users. So if you got, I've got friends on Facebook, I'll click on their birthday and they last posted in 2017. Advertisers don't care about that person. They're not an active user, but revenue per active user. So there I'm looking, how many active users do they add? Because that's what the advertisers are interested in, and then revenue per active user. That works really well. For firms like telecom or social media, you kind of want to know, telecom, it's how many plans do they have. With social media, it's what are the advertisers looking at? Are they looking at eyeballs, clicks? What is those kind of things? Because that's what they're going to pay for, and you want to look at your revenue per that. No one's doing an airline, but available seat miles, that's really important. So it's revenue not per how many people they're flying, but how many people they could fly. And you want to look at the revenue of that, because if you're flying half-empty planes, that's really going to kill this number, and you want to fill up those planes. No one's doing a utility, I don't think, right? So utilities have something called regulatory assets, which is what their base is on, their rate base is based on. So that's a really common revenue for regulatory assets, works really well. No one's doing energy, but you could do pipelines or proven reserves. There's all kinds of things. If your firm has a lot of CapEx, you could do revenue per CapEx. So if your firm is heavy in the CapEx, you want to know, hey, what are they getting out of all that capital expenditure that they're doing? Are they getting better or worse? So hopefully all of y'all have something that you can use. Allison's going to be kind of a strange one here, but it'll work. So let me tell you one interesting one. So let's talk Valero. We could do revenue to say PP&E. That would make sense. They have a lot of property, plant, and equipment. They have refiners. The problem with that is, what is their revenue? It's gasoline. So what does their revenue do when gas prices go up? It goes up. But why do gasoline prices go up? Because oil prices went up, right? So oil prices shoot up, like in 2022. Gasoline prices shoot up. Man, their revenue per PP&E looks wonderful. Did they do a good job? No, they just raised their prices. So what I would do for a firm like this, and probably doesn't apply to any of your firms, I would actually do revenue. Well, actually, I would do gross margin PP&E. What is gross margin? It's their gasoline minus the oil that they had to buy to produce. Because if oil prices go up, you're going to see their revenue doing that. Their cost of goods sold is going to do that. Their gross margin is going to be much more tame. So there are some firms, if you have a cost of goods sold that's just moving around like that, then you have to watch it. Now, a Starbucks, coffee prices go up. Well, they raise their prices. Yeah, but they got so many other costs going on with their employees. It's probably not going to be the same. Valero is a very direct thing. It's pretty obvious. that's going to go up and down. So there's a few times you might not use revenue and instead use gross margin. For most of you, just use revenue. I think this is one of the most important things a management firm is going to do. They got to really make sure, you know, it's not that hard to add revenue just by spending a lot of money, but you want management that's much more creative in that. So some of the best stories historically, my favorite story of all is McDonald's. What did McDonald's do to make their revenue turnover go through the roof in the 1970s? You're all too young to know. Y'all know I was alive in the 70s. There were people alive. We had electricity, didn't have computers. So they added breakfast. What happened when you add breakfast? How many new stores did they have to add? None. How much equipment did they have to add? I worked for McDonald's for 1 month. I watched them go from breakfast to lunch. It took them 3 seconds. They took this big thing and they scraped the grill and they started throwing hamburgers on it. I mean, no new equipment, some training, right? They had to train their employees. That took 7 minutes, probably more than that. That's pretty massive. Not only that, so revenue to assets shot up, and breakfast is a higher margin product. Their turnover shot up, their margins went up. Yeah, that's a huge win. And you saw their profitability just go through the roof. Now, can they do that again? Kind of running out of, you know, they've tried 24 hours. I don't see how that really helps them because the volume is just so low and your workers. If I'm a franchisee, the worst thing I want is a 24-hour operation because managing employees at 3 a.m. I don't want to know what they're doing in the store. No telling, but yeah, when you got minimum wage people at 3 a.m., who knows? But that's not doing much for them. You can start accepting credit cards. One of our bond put on Facebook a video about the first one. I think it was Burger King started doing credit cards. People are like, oh, this is so terrible, all this kind of stuff. But yeah, that can help you a little bit, but then everybody else does it. It's not going to really protect you all that much. So these type of massive wins aren't that frequent. Now they came up with another one. What was their second big win? So breakfast, that was number one. Any guesses? Huh?
Real estate?
Well, real estate is, I don't know how it has turnover. So that could be it. You'd have to look at that. But yeah, they're becoming more of a real estate company. How did they get to become a real estate company though? What did they have to do? Franchising, yeah. What does franchising do? So your revenues go down, that seems like it would hurt it. What happens to your assets? They crater, right? So instead of getting 100% of revenue, you're getting 15% of revenue, but you don't have to own any stores. So yeah, your revenue. So now how far can you go on that? 100% franchise is about as far as you can go. So they did that and that helped them a lot. So McDonald's has had these two massive changes and you just can't, well, I don't know how to spell franchising, but you can't do much more than what they've done. So what's the next big leg they're going to do? I don't know.
They said you were asking what did they do next, right?
Right. What could they do next that would be that dramatic? Well, they could go into other businesses, acquiring other restaurants. It just depends. If those restaurants have higher turnover, then yeah, it goes up. If those restaurants have lower turnover, it will go down. New products, you can try that, healthy products. But there tends to be a limit. You know, if the line in McDonald's is 10 deep, you're gonna have to add more stores. That's about the only way. And then, you know, so there comes a point with a restaurant, if you're successful, you have to increase your assets because you have to add more stores because people just stop coming because the lines are so long. So these kind of things you're thinking of, you know, how can firms really get these numbers higher? And it's not an easy thing to do. There aren't any just obvious things to do sitting out there for firms to try. Think about it with your firm. What could they do to really get this thing up there. So
Burger King for the alcohol.
yeah, selling alcohol, that you have to look at what the laws say, that increases a lot of costs, so you have to do the math to kind of see. Burger King did that Cinnabon, so sometimes a joint venture can work. I think Slotsky's has done Cinnabon kind of thing, so you could try that. That was a bigger turnover hit for Cinnabon than it was for Burger King, I think, but it was big. Cinnabon doing these joint ventures has been a huge part of their business, and so yeah, you can certainly, but that's why I love that Cinnabon podcast. Is she says, yeah, that's huge, but at the same time, we're losing control over our brand, so we have to control that. So none of these things, McDonald's, those are great with almost no downside, but most of them, you have to worry about the other side of this. So you got to make sure you talk about capacity versus the efficiency. That has to be in your discussion. You can do more than one ratio if you want to. So like on Lululemon, if you want to do inventory turnover and revenue per store, you could do both of them and talk about them similar. Where it gets frustrating there is they may be really great on one and not so great on the other. And then you have to kind of figure out, well, what's the math behind that? What's going on here? So yeah, how could they improve this? How could they get better? The operating cycle essentially are how many days that your sales sit in inventory, how many days you actually collect from your customers, and then minus accounts payable, which is kind of cost of goods sold over accounts payable. How long does it take you to pay your vendors? That could be a negative number, like for Walmart, where they collect from their customers before they pay their vendors. So that can certainly work. All right, so we kind of talk about these are kind of things you can do, but there's no obvious way to do this. Now, if you're doing revenue per employee, kiosk, I don't know, curbside pickup, can those things, are they material? I don't think they've been that material yet. I look at an HEB, they have this self-checkout. I don't think they're doing it for a revenue per employee kick. I think they're doing it customer service. There's people like me that want to get out 5 minutes faster and, just give me that line. Maybe airlines, I'm pretty sure airlines is not helping them. I think they have more employees than they did before the kiosk, but I don't know. It's possible. Is AI going to be, I don't have AI in there. Can AI be part of this equation? I don't know. Just think creatively to see, but what you're looking for is more revenue without a lot of effort. How can they do that? Because that's going to make the firm grow really fast. All right, so what we're going to look at is how fast revenues is growing. That's pretty simple. How much revenues is growing versus capacity, and then just a straightforward asset turnover. So we'll do Walmart here. So next week we should be able to finish everything for paper 3. Not that you're thinking about it yet, but you've got your paper 2 pretty well drafted this weekend, and so next week you can really start working. Nice thing about paper 3 is paper 3, and Dante can talk to this. Dante had to do paper 3 as an exam in class. So you can do this in an hour and a half. You can get a good draft. So it may not be great, right? Your exam probably wasn't as good as your paper, but you can in an hour and a half get through this pretty quickly. So your first draft shouldn't take you more than 3 hours, and then you go back and fill in those places that need more work. All right, I'll stop it there.